These companies posted earnings that exceeded Wallstreet estimates, but they all traded differently last week. How can you make sense of what the talking heads are predicting and initiate a position going into these earnings? The short answer, you don't. Hi, my name is Joseph Oksano and welcome to my YouTube channel, where we review the mechanics of how markets work to help you win this game of Wall Street. And in this video, we'll discuss big tech Q1 earnings, Wall Street's reactions, and where we trade from here.
Wilf, this is a beat on both the top and the bottom line, and the beat on the bottom line is substantial, earning 93 cents a share. That is better than the estimate of 79 cents a share. Automotive gross margins up almost a full percentage point, 95 basis points.
Tesla broke out of its triangle formation post-earnings, trading lower for much of the week. There were important stops hidden below these structure lows, which were taken out by price before the sharp rally back higher on Friday. This is significant considering market mechanics, as inventory have definitely changed hands. While we are still making lower lows and lower highs on a 60-minute time frame, on a 5-minute chart, the bulls have regained control as indicated by price trading above intraday structure highs, and the fact that we closed above these highs on Friday implied market strength. On a 240-minute time frame, Tesla is still forming higher highs and higher lows. So how Tesla trade on Monday very much depends on the outcome of this battle between the 60-minute and 5-minute traders, and see who ends up being stronger. We can get an early indication and clue by looking at the 200 EMA here at 725, which is also important structure, with price being respected both as support and resistance earlier during the week. This price convergence gives us a point of focus, a market fulcrum that we can use to determine whether Tesla trades higher or lower from here come Monday. If the 725 level holds Tesla down, we will likely test 240-minute F5. A clean break above 725 will indicate that the bulls have taken back control, and that strength can be confirmed by Tesla making higher highs and higher lows. Wall Street can also try to take out stops by pushing Tesla to these higher time frame support nodes, and either way, we will be looking at 725 as a market fulcrum for Tesla on Monday.
Those Wilf, big beat on the bottom line. EPS coming in at $26.29. That compares with a street estimate of $15.82. So a massive beat there.
Google kept out on earnings but have since traded within Wednesday's trading range, held back by Fibonacci resistance here. If there's price weakness early next week, we could see Google attempt to cover the gap or possibly retrace towards its 0.382 Fibonacci retracement level. Any pullback is likely temporary, as I expect Google to continue trending higher until we hit higher time frame resistance at QXOP and monthly XOP.
Sarah, Microsoft reporting Q3 earnings per share of $1.95. That's versus expectations of $1.78. Revenue $41.71 billion. Analysts were closer to $41.03 billion. Just looking through quickly the segments here: revenue and productivity and business processes, $13.6 billion. That's an increase of 15%. They say LinkedIn revenue is increasing 25%. Turning to intelligent cloud, $15.1 billion. That's an increase, they say, of 23%, driven by Azure revenue growth. They call out of 50% in the quarter. And finally, revenue and more personal computing, that's $13 billion, an increase there of 19%. Windows OEM revenue, they say, jumped 10%, and Xbox content and services revenue increasing at 34%.
Microsoft gapped down and traded lower after earnings, but market structure is still showing higher highs and higher lows. So while Microsoft could yet trade lower this week, as long as price stay above these structure lows and above its 200-day moving average, we should see Microsoft continue trending higher post-earnings week. We have 0.382 Fibonacci retracement of these lows at 248.26 and a 0.382 Fibonacci retracement of these deeper lows at 243.68. Note that a retest of previous structure highs at 246.23 reinforces this support zone.
Amazing metrics, GMV, take rates, total revenue, solutions. I guess the question is, how much should viewers think this is all tied to some of the stimulus checks that have driven all kinds of spending?
So let's be clear, we only succeed at Shopify when our merchants succeed. And I think our latest earnings demonstrate that more people are becoming entrepreneurs more than ever before. And those businesses, they're growing. In 2020, an entrepreneur on Shopify made their very first sale every 28 seconds on average. That's up nearly every minute in 2019. So Shopify is really this proxy for modern brands and entrepreneurs, and we now power about 1.7 million of them. And those merchants using Shopify in Q1 sold about $37 billion in the quarter. That's up 114% year on year. And that resulted in Shopify seeing about $988 million in revenue this past quarter, which is about 110% increase year over year. So that means that for every dollar of Shopify's revenue, our merchants are generating about 40. But it's also becoming clear, to your point, that small businesses are really the rebuilders of this economy. And that's something we're really exciting about. And I think we're this rare breed in that we were this wonderful pandemic story, and we're now transitioning to being this global recovery story as countries open up and we see growth continuing.
Shopify reacted off its 200-day moving average, trading higher going into earnings, and later gapped up on Q1 earnings, only to give up all its gains, retracing back to cover its gap. This retracement happened after hitting the 0.618 resistance node off from this market swing. We are currently sitting on top of the 0.382 support of this market upswing, and Fibonacci expansion of this market swing gives us these resistance nodes to watch this week. While the bear case will still remain if we trade below its 200-day moving average and break below structure lows, I believe it is more likely for Shopify to continue trending higher towards XOP resistance nodes near previous highs.
2%. Facebook up 7% in after ads. The numbers crossed just there as Phil was chatting, and a big beat similar to Google, driven by advertising. Revenue coming in at 26.2 billion. Forecast was 23.7 billion. The advertising revenue at 25.4. The forecast there was for 23 billion. So as I said, driven by that advertising number. The EPS beat on the bottom line, significant. 330 per share. The forecast was for 237.
Facebook had a strong gap up on earnings beat and retraced lower post-earnings to revisit its quarterly OP node. The fact that Facebook opened significantly above this node resistance then becomes support, and a revisit will usually produce a strong intraday reaction, as we saw last week, with Facebook bouncing off QOP before closing the week back against it. The fact that we closed the week above quarterly OP gives us a slight bullish bias for Facebook to continue trading higher this week. In a less likely event when we break support, we have Fibonacci retracement nodes against structure, which should provide further support.
You looked up blowout earnings in the dictionary, it would be Apple's March quarter. I mean, this is what I almost say is the dream scenario for the bulls. In terms of what you see on iPhones, services is of course on the buyback as well. This really just shows, many skeptical about the super cycle. You look at this quarter, this sort of puts the, what I believe is the exclamation mark that the super cycle is alive and well. This looks like this is going to be Apple's historic year where they'll break 231 million iPhones. I think right now this is the catalyst to get this to $175, $200. This is really, in my opinion, probably the best quarter I've seen from Apple in the last 18, 24 months.
Apple was trading higher going into earnings, making higher highs and higher lows, and the stock briefly traded higher before losing all its gains, making a lower low here, suggesting some price weakness. That's it. There's a 0.382 F3 support here, which is reinforced further by previous structure. I expect Apple to eventually trade higher towards higher timeframe resistance nodes, as long as price stays above its 200-day moving average and important structure lows.
Amazon releasing results last night, and the company's profit tripled, pushing this quarter to its best performance to date. What did you make of this quarter? It was a blowout. We're talking to Mark Mahaney in the last hour, and a lot of us have talked about, did the pandemic pull forward certain things, and is that sustainable? And he called it a permanent pull forward. Is that what's happened here?
Well, we'll see. And I think that one of the questions is what's going on internationally. Amazon was particularly strong there. And I think that the United States is actually now ahead of some of the rest of the world in recovery. So we'll see if there's some pull forward there. But I think it's sustainable. I do think it would be unrealistic to think that when all the stimulus runs out and the economy gets fully back to normal, we won't see some adjustment at Amazon and other companies. I would think that would be reasonable to think.
You just said when the economy gets back to normal, but and when the stimulus runs out. But depending on what you think is about to happen in Washington, we may have stimulus in some regard for many years to come.
We may, but we'll also probably hit a peak of it within the next 6 months or so. And then the question is what happens on the other side. I mean, things are just extraordinarily strong now, certainly in advertising. We saw this with tech. Amazon's benefiting from that too. There's still an enormous amount of consumer spending that's going into Amazon and others. But I do think that at some point we're going to reach a peak of that stimulus. And then we're going to gradually go back to the organic economic growth. And I think that what we often see is that the stock market is peaking around the time that you are just at that absolute peak of enthusiasm and things couldn't be any better. And that's the time to sort of wonder and say, okay, where are we going from here?
Amazon has been consolidating against its quarterly OP, but already made its way higher, confirming its bullish bias by taking out structure highs going into earnings. We briefly traded higher post-earnings before losing most of its gains, but crucially, we are still staying above previous highs, suggesting market strength. Overall, price is still making higher daily ranges, so I'm still seeing market strength and expect Amazon to trade higher. We have Fibonacci expansions that could serve as resistance this week, with big resistance node at monthly XOP. While these 7 tech companies all announced earnings that beat Wallstreet estimates, they have all traded differently post-earnings. So to try to predict how stocks will trade based on some superior fundamental or technical analysis so close to an earnings report is often a losing proposition. Most day traders avoid taking leveraged positions who would likely liquidate any position taken on an intraday basis, going net neutral, and try to reposition after making sense of Wall Street's reaction to the event. And as you can see after last week's much hyped up Q1 earnings, there are now good possibilities to get back involved safely without having to deal with the risk and big gap downs against your position. You could also use advanced option strategies to play both sides of the market without the risk. Now, a seasoned investor and higher time frame swing trader would have determined their investment thesis and made their stock purchases weeks and months before earnings at much lower prices. This would afford them some room to stay in their positions without having to worry about the volatility surrounding the event. So the only people trying to initiate new positions on an intraday basis going into any major earnings report or event are the speculators that Wall Street are trying to screw with. Size is the enemy of the knowledgeable trader, and even the best of us have made these mistakes at some point in our careers before we develop the discipline to work against these tendencies. Now, I know all this may sound like a conspiracy theory, but let me further prove my point. As stock traders, we all look at the equity index futures as a clue to how equity markets will trade. If the index futures were bullish, US equities are expected to trade higher in general. And the reverse is true. Last week's earnings was portrayed as one of the most important week in Q1 of 2021. So everyone was trying to position for some sort of continuation move, whether it is in stock options, equity index futures. Let's look at how the equity index futures traded this week. In a previous report, I've identified quarterly XOP at 4178.5 to be an important market fulcrum. Seasoned traders proficient and trained in advanced Fibonacci analysis will look at this price level as an important market fulcrum, adopting a bullish bias if price trade higher off it and a bearish bias if markets trade lower from it. We started the week trading near this quarterly XOP and we ended the week at exactly where we started. In a week where global investors were paying a lot of attention to the markets, I would say that this is by design. Options traders positioned for momentum would have seen their call and put options expire worthless, debit spreads would have seen their premiums decimated, and futures traders would have been whipsawed on both sides. And that is exactly how Wall Street stands to gain the most going into the most hyped up earnings week in Q1. What I'm saying is that markets closing the week right back at 4178.50 is not a coincidence. Now that everybody already made their move last week, Wall Street will soon make theirs. This is how the game is played, and if you want to learn why Wall Street does what it does, how we calculated this market fulcrum ahead of time, examine why we expect markets to eventually trade higher from here, and what we need to see in order to confirm that bias, in the next video, we will discuss all of that.